Most credit card holders hurt their finances without ever realizing it. Not because they're careless, and not because they're bad with money, but because no one ever explains how credit cards actually work behind the scenes. In this video, we're going to break down every common mistake credit card holders make, why those mistakes matter, and how they quietly affect your credit score and financial life. No tricks. No judgment. Just clear explanations under 10 minutes. In our last video, we explained how credit scores work in the United States. This video builds directly on that because most credit card mistakes don't look like mistakes at all. They look normal. They look harmless. And that's exactly why so many people make them. Mistake number 1, paying only the minimum balance. One of the most common credit card mistakes is paying only the minimum balance every month. Credit card statements make this option look safe. You paid something, so everything must be fine, right? Not really. When you only pay the minimum, most of your payment goes toward interest, not the actual balance. That means your debt shrinks very slowly, even if you keep paying on time. Over time, this keeps your credit utilization high, and high utilization hurts your credit score. More importantly, it keeps you stuck in a cycle where you're always paying, but never really getting ahead. Paying the minimum isn't wrong, but treating it as a long-term strategy is a mistake. Mistake number 2, using too much of your credit limit. Another very common mistake is using too much of your available credit. Even if you pay on time, using a large percentage of your credit limit can hurt your credit score. This is called credit utilization, and it's one of the most important factors in your score. As a general rule, using more than about 30% of your available limit starts to look risky to lenders. For example, if your card has a $1,000 limit and your balance is $800, that's considered high utilization even if you pay the bill every month. To the system, high usage suggests financial pressure. This is one of the most confusing parts of credit cards, because you're technically allowed to use the full limit, but doing so too often works against you. Mistake number 3, missing a payment by just a few days. Many people think a late payment only matters if it's very late. In reality, payments that are 30 days late or more can be reported to credit bureaus, and once that happens, the damage is serious. Even one missed payment can stay on your credit report for years. What makes this mistake dangerous is that it often starts small. Forgetting a due date assuming autopay is set up. Being a few days short on cash, credit card companies don't care about the reason. Once the payment crosses that reporting threshold, it becomes part of your credit history. Consistency matters more than perfection, but missed payments are one of the fastest ways to hurt your score. Mistake number 4, closing old credit cards. Closing a credit card can feel like a responsible decision. You might think, I don't use this card anymore, so I should close it. But closing old cards can actually hurt your credit score. That's because it affects two things: your credit history length, your available credit. Older accounts help show stability. They prove you've managed credit over time. When you close them, your average account age drops, and your total available credit shrinks, which can raise your utilization ratio. Unless a card has high fees or causes spending problems, keeping old accounts open is often better for your credit profile. Mistake number 5, applying for too many cards too quickly. Every time you apply for a credit card, the lender usually runs a hard inquiry on your credit report. A single inquiry isn't a big deal, but several applications in a short time can add up. To lenders, this looks like financial stress or desperation, even if that's not your intention. Multiple inquiries can temporarily lower your credit score and make you look riskier. Spacing out applications and applying only when you actually need credit is a smarter long-term approach. Mistake number 6, treating credit cards like extra income. This is one of the most dangerous mistakes and also one of the most psychological. Credit cards don't feel like real money. You swipe now, and the consequences come later. That delay makes it easy to spend more than you would with cash or a debit card. But credit cards are not extra income. They're borrowed money, often at high interest rates. When spending isn't aligned with your actual income, balances grow, stress increases, and financial flexibility disappears. Credit cards are tools. But like any tool, using them without understanding leads to problems. Mistake number 7: ignoring your statements and credit reports. Many people never look closely at their credit card statements or credit reports. That means fees go unnoticed, errors stay uncorrected, fraud takes longer to catch. Reviewing your statements helps you stay aware of how you're using credit, and reviewing your credit report helps you spot problems before they grow. Ignoring these details doesn't cause immediate harm, but over time it creates blind spots that can cost you. Mistake number 8: assuming autopay means you don't have to pay attention. Many credit card holders rely completely on autopay and assume that means everything is handled. Autopay is helpful, but it's not a replacement for awareness. Autopay can fail. Bank accounts can have insufficient funds. Minimum payments might be set instead of full balances without you realizing it. When that happens, people are often surprised by late fees or interest charges they didn't expect. Autopay should be a safety net, not a blindfold. Checking your statements and confirming payments actually went through is still part of responsible credit use. Automation helps, but ignoring your accounts entirely is a mistake. Mistake number 9: using credit cards for emergencies without a plan. Credit cards often become the default solution during emergencies. Unexpected medical bills, car repairs, or sudden expenses get charged to a card, and in the moment, that feels like relief. The mistake isn't using the card. The mistake is not having a plan to pay it back. Emergency charges often turn into long-term balances, which then collect interest month after month. Without a clear repayment strategy, one emergency can quietly turn into years of debt. Credit cards should support emergencies, not become permanent emergency funding. Understanding the difference matters. Mistake number 10: thinking one good month fixes everything. Many people believe that one good month can erase several bad ones. They pay on time once. They reduce their balance once. And they expect their credit score to bounce back immediately. But credit scores are built on patterns, not single actions. The system looks for consistency over time, on-time payments month after month, stable balances over multiple cycles, responsible use over years, not weeks. Improvement happens gradually, and that's intentional. Expecting instant results often leads to frustration, even when you're doing the right things. Patience is part of credit management. Credit card mistakes don't usually come from bad intentions. They come from misunderstanding how the system evaluates behavior over time. Most of these mistakes feel small in the moment, but their impact adds up quietly. Credit cards aren't shortcuts. They're tools that reward consistency and awareness. Avoiding these mistakes isn't about being perfect. It's about understanding the rules you're playing by. And that understanding is a core part of money mastery. If you want to keep learning how money systems actually work, you're in the right place. This is Road to Money Mastery, and this is just one step on that road.